hardly any surprise that we've seen this ticking higher and smack bam in the middle of expectations that were out there.
Yes, no, absolutely in line with expectations, so no surprises there. I think the key factors, what everybody anticipated it would be, it's your crude oil prices coming through in a very vicious way that also pushed up imported inflation in a very dramatic fashion. I think you had a 5.9% month-on-month increase in crude oil and natural gas, and we're now standing at a year-on-year rise of 23%, so that is pretty dramatic stuff.
And it's set to get worse moving forward because we've got, further fuel price rises being anticipated, electricity tariff increases, toll fees. So the pressure is certainly mounting towards the upside.
Absolutely. And I mean, in this particular producer inflation, it's all cost pressure. It's all sort of your big commodities. It's crude oil, it's chemicals, it's coal. So that's where we're seeing the price pressure coming through. But funny enough, on food, things remain very benign. On the food side, we actually saw a decline of 1.9% over the month. On a year-on-year basis, we still don't really have food inflation. It's 0.9% year-on-year. And that's fresh produce prices, so that's at the raw level. Then if you take it a step further at the manufactured level, you are seeing a little bit of price pressure coming through, so that's where the impact of imports coming through. And there it was an increase of 0.5% over the month, and you're just over 2% year-on-year.
Begging the question then, when are we going to see this now filter through, where we're going to have producers and retailers actually passing on some of these input costs to the consumer, because commentary has been that they've absorbed a lot of it to a large extent thus far?
Yes, I think they have. I don't think it's because they're saintly. I think it's because they basically have had to. And I think that the reason for that is that the consumer, although they've returned to the stores, they're shopping, we're seeing retail sales is rising at a fairly brisk pace of just over 6%. The reality of the matter is that I think they remain very cautious. They remain very price aware. So if you were to push up prices quite dramatically, consumers will notice. It's not quite that sort of buoyant environment where they carefree and optimistic and just buy irrespective of price. So I think price is still a big factor. It's still a very vulnerable consumer, although they are spending again. And I think as a result of that, retailers are aware of the fact that they can't be too aggressive in restoring some of their margins. But ultimately, I think the consumer is also more educated. The consumer is well aware of these cost hikes. Petrol prices they're well aware of. Make no mistake that the rise in electricity tariffs, I think, have affected people's disposable income in a very dramatic fashion. I mean, just anecdotally, walking around, speaking to your friends, everybody mentions it. So people mention it, they feel it. And then, you know, there is, I think, a growing fear that you might see interest rate hikes in the second half of this year.
Absolutely.
And early next year.
And certainly tomorrow's credit extension numbers are going to be a telling sign as to the health of the consumer right now, right?
Yes, I think so. And that's the one area where we've seen the vulnerability of the consumer. So even though they've spent, it's been very selective buying, and it has not translated into rapid growth in credit. So at the moment you've got consumer spending, but it's not associated with any credit bubble building up. So there's no real demand pressure on prices at this point, which I think is also why the Reserve Bank is reluctant to act too quickly on the cost pressures they're seeing at the moment. And I think that credit will tick up higher when we get our numbers tomorrow, but it will still be a very subdued picture. I don't think there are any banks at this point that can report any sort of surge in credit demand coming from households.
What's your outlook on the CPI front?
On the CPI front, we've actually now, as a result of these very negative numbers, the negative developments, certainly in terms of commodity prices, we have now adjusted our inflation forecast up. We had it initially at just below 6% at the end of the year. We've now upped it to 6.1% for year end, and then hovering around that level throughout 2012. So certainly, if the Reserve Bank were to respond on a very narrow inflation targeting basis, they would already have had to have hiked.
Yeah.
You know, considering it takes 12 to 18 months for an interest rate to have any kind of impact on price levels. So if you look at it from a narrow base, they should have acted quite some time ago. Yeah. And I think that's why the reason the market is saying, well, they will definitely act in the second half of the year. However, we're saying I think they learned from the experience of 2007, 2008. They no longer have such a narrow mandate. We all know the infamous letter that was written to the new governor of the Reserve Bank. So there's political pressure to take in mind and bear in mind what is happening on the economic front, what is happening on the jobs front, where things are not really improving. You may have growth, but you're not seeing significant job creation at the same time. So I think they will try and postpone that hike as long as they possibly can, and they'll watch out for second round effects. And at this point, there is no evidence of that.
Yeah, of course, a lot will also depend on whether the rand manages to hold on to the strength, where that carry trade position is still, it seems, a very big factor to consider. It seems that we're looking at a stronger rand for longer here, given the kind of comments we've heard out of the FOMC in the US yesterday.
Well, certainly they're not going to yield to pressure to just sort of abruptly end their quantitative easing, which means a weaker dollar. At the same time, they really are not in a position to hike rates. I think the EU is very brave and perhaps even foolish to have hiked rates so early on in the cycle. But in the US, they honestly aren't. I mean, I think they're well aware of the fact that their consumers are as vulnerable as everybody else. There is a real cost squeeze on consumers globally. So consequently, I don't think they're going to be moved in any way or rushed into tightening policy very quickly at all, which means there is a base or a case for a stronger rand against the dollar anyway, which is the currency that matters when we look at commodity prices and the impact that will have on inflation. And so the rand should be our friend for a while still to come. Of course, it's not the friend of the exporter, and it is overvalued, and so at some point a correction must come.